Eric Sabatini, mortgage agent, here with another mortgage scoop for you again this week. This week I want to discuss commercial financing. Now, although I do have access to lenders who will consider up to 8 units on the residential side, most every other lender considers any building with more than 4 units under its commercial financing portfolio. Similarly, anything zoned as commercial, so C1, C2, will most often fall on the commercial side. But here's a little fun fact for you, okay? If you are looking at a commercially zoned property that is and has been used for residential purposes for an extended period of time, I do have lenders who will consider this on the residential side with a good story. After all, and I do argue this all the time, the best storyteller will win when it comes to financing. Commercial financing is a lot different than residential financing, however. While when we qualify for a residential mortgage, the focus is on your client's income, credit score, down payment, qualifying for a commercial mortgage involves some different factors on top of this, okay? So number one, property income and cash flow. Lenders assess the income potential of that specific property. They want to make sure that the property can generate enough income to cover the mortgage payments and other expenses. So I'll give you an example. My most recent commercial deal, the lender wanted to see a debt coverage ratio of 110%. This means that we needed the entire mortgage payment and other expenses to be covered by the income generated, plus have an extra 10% on top of that to satisfy the lender. So the mortgage payment plus all the other expenses was $8,700 for this specific property. The income generated each month was $9,850. So I was at 113%, which satisfied the lender's requirements. So I want you to be aware that in any commercial opportunity, lenders will ask for financial statements or rent rolls to evaluate the property's income and cash flow, okay? Number two, lenders may ask for a business plan, and a detailed business plan which outlines how your clients will run the business, generate income, manage expenses, okay? It helps lenders understand the viability of the business and how the borrowers intend to repay the mortgage. I can help with a lot of that. Number three, experience and financial stability. Lenders also consider the experience and stability of the borrower. They may review financial statements, credit history to assess one's ability to handle financial responsibilities and the commercial mortgage itself. Number four, down payment and loan to value. This is the biggest question I get with commercial. Okay, mortgages to purchase commercial real estate are typically available up to 75% of the appraised value or as high as 85% loan to value on multifamily properties under CMHC insured program. We can do amortizations up to 40 years depending on the building's age, location, physical condition, its lease profile, the debt coverage ratio like I talked about. However, in most scenarios, the down payment percentage is based on the property. So for example, a storefront with apartments above can get done at 20% down payment, whereas a commercial plaza mortgage or office mortgage usually requires 25 to 35% down payment. I know the general rule of thumb is 35%. I hear it all the time. Commercial real estate means 35% down at least, right, Eric? Sometimes yes, sometimes no. Ultimately, it comes down to the income versus the debt for the lender. If we can put down 20% and generate enough income to pay back the mortgage and other expenses and have a little bit left over each month, then lenders will generally be fine with the positive debt coverage ratio, okay? Remember what I mentioned above. Not all commercially advertised properties fall under a commercial portfolio. An 8-unit building can get done on the residential side given the right circumstances. Similarly, a triplex on a main street that is commercially zoned doesn't necessarily require commercial financing. Telling the right story to a lender is what separates a good mortgage agent from a great mortgage agent. Make sure your clients have the best in their corner. They'll never go anywhere else with their business. Happy selling, my friends.